Gold is considered a safe investment during economic uncertainty, but choosing the right one among so many investment options can be challenging. Tata Gold ETF is emerging as a popular option for Indian investors, but is it really the best option? Let's understand whether it should have a place in your portfolio by analyzing its features, performance, and alternatives. Gold ETFs and their role in modern portfolios. Gold exchange-traded funds, ETFs, are financial instruments that track the price of physical gold, allowing investors to invest in gold without the hassle of storing coins or bars. These funds are traded on the stock exchange, making them as liquid as equities while maintaining the stability of gold. How does Tata Gold ETF work? Tata Gold ETF aims to reflect the performance of physical gold in the domestic market. It invests at least 95% of its assets in gold and gold-related instruments, while the remaining amount is held in cash equivalents to maintain liquidity. As of March 2025, this fund had assets of 374 crore rupees and an expense ratio of 0.42%, which is competitive compared to HDFC Gold ETF 0.82%, and ICICI Pru Gold ETF 0.59%. Performance analysis. Tata Gold ETF versus other competitive funds. Short-term and long-term returns. In the past year, Tata Gold ETF has given a return of 31.37%, which is slightly less than HDFC Gold ETF 32.16% and Aditya Birla Gold ETF 32.45%. However, looking at the long-term performance, its 3-year return has been 19.15%, which is significantly lower than Nippon Gold ETF 56.24% and SBI Gold ETF 56.99%. This means that while Tata Gold ETF short-term performance is good, some other ETFs may prove to be more stable and profitable. Tracking error and efficiency. It is important for ETFs to track gold prices with accuracy. Tata Gold ETF's portfolio allocation is 97.44% in commodities and 2.56% in cash, keeping it close to its benchmark. However, the expense ratio of 0.42% can affect investors' returns in the long run. For example, Quantum Gold ETF has an expense ratio of only 0.12% and has given a return of 85.03% in 5 years, while Tata Gold ETF's return has been only 19.15%. This shows that low-cost funds can provide more benefits in the long run. Risks and limitations of Tata Gold ETF. High-risk rating. SEBI has placed Tata Gold ETF in the high-risk category, which reflects the volatility of gold. Gold usually acts as a hedge against inflation, but its prices are affected by global demand, currency exchange rates, and geopolitical events. Therefore, its volatility can be detrimental for risk-averse investors. Tax impact. Gold ETFs are taxed like debt funds. Investments held for less than 3 years are subject to short-term capital gains tax, which is according to the investor's income tax slab. At the same time, long-term capital gains tax of 20% is applicable on holdings of more than 3 years, but indexation benefit is available. In comparison, sovereign gold bonds, SGBs, can be a better option, as interest income is tax-free and there is no tax on long-term capital gains if held till maturity. Sovereign gold bonds. A strong alternative. Guaranteed returns and tax benefits. SGBs offer 2.5% annual interest, which is in addition to the increase in gold prices. Apart from this, there is no long-term capital gains tax if they're held for the entire 8 years. For example, if someone has invested 10,000, 12,500 can be obtained from interest alone in 5 years, which is not possible in ETFs. Compromise with liquidity. SGBs have a lock-in period of 5 years, which makes them less liquid compared to ETFs. ETFs can be traded on any day, which provides more flexibility to investors during market fluctuations. Experts' opinion and market sentiment. Analysts' warning on gold ETFs. Financial experts believe that gold is not ideal for long-term wealth creation, as its historical returns have been lower than equities. They advise retail investors to prioritize SGBs, as interest income and capital gains are tax-free. Recent performance trends. In early 2025, the NAV of Tata Gold ETF was 8.42, and it gave a year-on-year return of 12.22%. However, its fellow fund, Tata Gold ETF Fund of Fund, managed to give a 33.61% return in the same period, although it had higher risk and an expense ratio of 0.16%. This shows that it is important to strike a balance between direct gold investments and fund of fund structures. Conclusion: is Tata Gold ETF the right choice? Tata Gold ETF is a convenient and liquid medium to invest in gold, but its higher expenses and lower long-term returns make it less attractive compared to other options. Its liquidity can be beneficial for short-term traders, but for long-term investors, SGBs can be better due to tax savings and interest income. Final recommendations: 1. Short-term investors. If liquidity and easy trading are priorities, Tata Gold ETF can be a good option. 2. Long-term investors. Prioritize SGBs as they offer tax benefits and guaranteed interest. 3. Low-cost investors. Choose options with lower expense ratios, such as Quantum Gold ETF or Nippon Gold ETF. Gold can overall be a 5 to 10% portfolio stabilizer, especially during market fluctuations. Assess your risk tolerance, investment period, and tax plan before investing, or seek guidance from a financial advisor. Keeping these factors in mind, you can decide whether Tata Gold ETF suits your financial goals or whether another option can better illuminate your wealth-building journey.